So welcome to the Kenny and Kenny Best Practice webinar series. Today we're going to cover uh, financial control and decision clarity and uh, why it's important to you. This is something that you should always insist on as a taxpayer, as a business owner, and we're going to talk a little bit about why and how the PFS, which is the Personal Financial Specialist designation that we have as a firm, is important to help you do that. So, little legal disclaimer. We've made every effort to create accurate, timely, uh, and informative information. You're welcome to use any of it. In fact, we post all the recordings shortly after the meetings, and you're welcome to use those. If you want our help on implementing any of the content, feel free to reach out to us. So today we're going to cover why financial control and decision clarity is important, what a PFS is, and we're going to look at wealth planning, risk management, cash flow optimization, tax planning, all through the lens of a PFS. And then we're going to bring it all together in a case study so you can see how it actually works. And hopefully at the end of this webinar, you'll feel like this is your roadmap to financial clarity. So why it matters. So I think today more than ever, we have more choices and it's more complex to navigate the waters of personal financial planning. And all of these main areas, wealth, risk, cash flow, taxes, they all either directly or indirectly impact each other. And so when you coordinate them all in a cohesive, comprehensive plan, you reduce stress, you improve your outcomes, you keep more of what you earn, and hopefully move more confidently toward your long-term goals, financial goals. So what is a PFS? So it stands for Personal Financial Specialist, and it's a CPA with advanced expertise in personal financial planning. And the PFS is trained to take a comprehensive, integrated approach that connects your wealth, risk, cash flow, and tax strategies to help you achieve your lifelong goals, primarily financial. So the PFS through looks at wealth planning in this way. So number one, if it's a household, we want to help work through the investors' different goals and risk tolerance to come up with an investment policy statement that is reflective of where both are at. Because oftentimes with the markets, they can be up and down. And so the main thing is having an investment policy statement that both are comfortable with. So when there is a down year, you have uh, a plan in place that allows you to kind of navigate those rough waters. And also wealth, especially in our practice, we're mostly focused on businesses. So retirement planning, education come into play. And hopefully you're in a spot where you can do some legacy planning. We look at help the help the client look at asset allocation and portfolio tax efficiency, and then help monitor long-term objectives. Next, it's important to look at risk management and identify any risks that could derail your plans. So some that come up are premature death or disability. If you have some health concerns, long-term care, but getting that in place if it's relevant while it's affordable and available, limiting liability exposure, market and inflation risk, and business owner risks. If there is a business, making sure that there is a succession plan in place. Also, want to look at cash flow optimization, which involves understanding the personal income and expenses, create spending and saving strategies. One of ours that we deploy with businesses is profit first, and then look at debt and managing that efficiently. And if there's any major purchases in the future or life transitions, say into retirement, that we plan for those and have those as part of the comprehensive plan. Tax planning, we're always interested in helping you keep more of what you earn. And when you think about your earnings pie, a lot is going to taxes no matter what. So we're always looking to identify tax saving strategies in our planning, coordinate your investments so that that we minimize the tax impact where possible, and optimize your retirement contributions and withdrawals based on your needs and long-term goals. And then plan for capital gains, identify them and minimize them. If you're charitably minded, we want to make sure that you're giving efficiently. And then also looking to minimize estate taxes and business taxes. So now we're going to pull it together, hopefully, for you in a case study and look at the power of integration of all of these main areas. Again, wealth, risk, cash flow, taxes. And we're going to look at a high income business owner approaching retirement with a complex financial life. They want to retire in 10 years, own an S Corp. And the results we're hoping for are lower taxes, improved cash flow, better risk protection, and more confidence in retirement. So our case study, we've got Joe and Susie, biz owner. They're both age 55. Joe's the president and CEO of Hometown Wealth, Inc. It's an S Corp that they co-founded 10 years ago. Their goal is to retire in 10 years. Joe's a driven entrepreneur and he's okay with risk. His co-owner and wife, Susie, is a VP and CIO of Hometown Wealth. And she shares the goal of retiring in 10 years, but she's cautious and plans ahead. A little bit about the economic environment. Some of the keys on the tax front are they have an effective tax rate federally of 17% with a marginal of 24%. And the state tax rate for them is 8%. And the current rates for a 30-year are 4.5 and 15, 3.85. So This is how their balance sheet and cash flow statement look. It's important to get this information in place, and we can see that they've got a net worth of in excess of $1 million, and they've got some life insurance with cash surrender value. They own their home. They've got a loan on the home, a small credit card. Their cash flows. They've got they both make 110,000 on a W-2. They've got interest and dividends of $10,000, capital gains of 5,000. So their total inflows are 235,000, and they've got these outflows, taxes, 50,500. Their fixed expenses, which include the mortgage, automobile, car payment, and insurance of 42,000, and then they've got 65,000 that they spend on variable expenses like food and clothing. So they have a net available for saving and investment of 77,000. So looking at their planning priorities, these would be some of the PFS type recommendations. So, they're looking to retire in 10 years. So it's important to make sure that they're funding retirement. They're in the 24% marginal bracket on federal and 8% for state. So looking at a solo K, and if we go back, there's no retirement account. It's just a taxable account in mutual funds. So to get to retirement, most likely we're going to need a 401k or profit sharing plan. And so assuming that they're the only employees, they can affordably implement a solo 401k. Next, they own a business. It's valued at 500,000. Based on their salaries, it's probably that they probably don't have a valuation, and that's probably the net worth within the business for book. But if they are realistically going to retire in 10 years, they need to figure out a plan to deal with the business over that 10 years. Either they need to plan for a sale or succession with some of the employees. And at a minimum, they need to align the business exit timing with retirement. So this is going to be a critical planning item. When you look at their net worth of just over $1 million, probably more than half of it is tied up in the business. So this is going to be key. Investment strategy. Again, they've got mutual funds that are taxable, hence the interest and dividend income. So be looking to potentially look at whether they need to rebalance for tax efficiency or diversification. And based on their investment policy and their goals and assets, determine whether they need greater than a 6% return. Cash flow and spending, they've got a $77,000 per year surplus. So we want to look at optimizing that deployment. Maybe some of that is going into the solo K. And looking at insurance, we want to look at the beneficiaries of the life insurance plan, and look at the adequacy. So if something happens to Joe or Susie, we need to make sure that that the insurance creates enough liquidity in the business so it can succeed. And then with the whole life policy that has only a $35,000 cash surrender value, we may want to consider cashing that out and redeploying it maybe for some term life that covers them over that period prior to retirement. And then we don't know what their coverage limits are, but we would want to look at that and make sure that having a net worth of $1 million, we'd want to make sure that the liability coverage for the home and the auto are adequate so that a liability doesn't derail their plan down the road. And finally, we look at estate and tax planning. They're a community property state, so we want to look at the titling of their assets. Looking at their mortgage, depending on where they're at in these other areas, probably makes sense to keep the mortgage where it's at. 3.85% is below where the rates are currently, so we probably hold off on that. We did learn that they are giving 23,500 per year. We may want to explore a donor advised fund for them, or look at some of those appreciated assets to gift those and get the tax deduction for the charitable contribution and eliminate the capital gain on that sale. So the PFS coordinates all of these 6 areas. So we're not solo planning in one area. We're not just looking at any of these exclusively of the others. We're trying to integrate them all in a plan that makes sense to help Joe and Susie achieve their retirement goal of 10 years. So again, these are the main areas, and as you can imagine, decisions in each of these areas impact the others. And so the goal is to help you see the big picture, make coordinated decisions, one plan, greater clarity, better results. So ideal candidates for this type of planning would be high income professionals and families, business owners, someone approaching retirement, someone with significant investments or assets, or anyone seeking greater clarity and control over their financial picture. So we've got some time to open it up for questions. So with that, I'm going to stop sharing my screen and see if anyone has any questions. All right, well, I'm going to reshare and close. So your next steps would be to potentially look at your financial picture, identify opportunities to improve and create an integrated plan, review and adjust over time. If you're interested in exploring this further, you can go to our website at kennycba.com and book a meeting. and be happy to talk through this with you and see if we can help you with your uh, financial goals and dreams. So thank you all for joining me and us, and we'll look forward to seeing you next month.